Let me welcome everyone. Let us start, and let me invite our Group CFO and member of the board, Mr. R. Shankar Raman, to give you the presentation. Thank you.
Good afternoon. Thank you for being here this afternoon for our first quarter's results announcements. The presentation starts with the usual disclaimer on forward-looking statements that could or may not play out as time goes by. We divided our presentation into the group performance highlights, followed by details of the segment, and possibly in the course of the presentation we will cover some aspects of the outlook as well. The company has performed very well during the quarter ended 30th June 2018. The strength of the performance is borne out by the fact that across various parameters, the company has done very well and exceeded the previous year's first quarter numbers handsomely. The order inflow has grown by 37% as compared to the previous year's first quarter. Because of the 19% increase in revenues, there is also a moderation in the order book growth by about 3%, but that's fine considering the fact that the momentum for picking up orders and executing underlies the movement of these numbers. The most satisfying part of this is the ability to work profitably, and the profitability has improved in terms of EBITDA margins by about 160 basis points, which translates to a 40% growth in EBITDA year on year for the first quarter. Consequently, the profit after tax moves up smartly by 36% as compared to the previous year's first quarter. Looking at the results in some detail, let me start with the order inflow, which is where all of that exercise for the company's performance begin. During the quarter ended 30th June 2018, we have secured orders worth 361 billion rupees, and the 361 billion rupees is a 37% growth over the 264 billion rupees that we won during quarter one of the previous year. If you look at the 361 billion rupees, we find that nearly 74% of 361 billion rupees is from domestic orders, and the international orders at 94 billion rupees represents a 26% share. Insofar as domestic orders are concerned, we saw a 45% growth as compared to the quarter one of the previous year. 185 billion rupees was the orders that we picked up from domestic markets in Q1 of the previous year, and in Q1 of the current year we picked up 267 billion rupees. And much contrary to the expectation that the international order inflow would slow down consequent to the geopolitical crisis, plus the tweets and retweets and the oil prices, we found that the international orders actually improved during the year-on-year period from 79 billion rupees to 94 billion rupees, which is a growth of 19% over the first quarter of the previous year. If you reflect on the order inflow, what we find is a fairly strong tendering activity, which means that the sponsors of these projects are beginning to look at opportunities to put capital to work, to create infrastructure and capital assets. And that's good news, because I think it's very important for both the industry and the company to ensure that there is robust growth in the order inflow backed up by the investment momentum. We also found, as I mentioned just a little while ago, the international opportunities are beginning to improve as compared to the softness that we saw exactly a year before. Much of this activity is triggered by the government programs on developing the country's infrastructure, and hence a combination of government programs sponsored by either the PSU's own cash flows or the multilateral funding agencies supporting the programs These have been the main reasons why public order, I call it public order, it's government stroke PSU stroke government programs, both state and central, they have moved forward on this basis. Private sector, we find that in pockets investments are happening. They are in obviously sectors where a lot of consumption is seen, like the automobile or construction mining equipment. But in the metal space with which the company is intimately connected, much of the investment currently happening are to pick up the stressed assets that are available. So consequently, we find that the investment, either brownfield or greenfield, directly into sectors is not as strong as it once used to be. But I guess private sector by and large is on wait and watch mode, and would possibly make the moves once the environment is conclusively favoring economic activity for their respective businesses. The infrastructure has been the main lever for growth of orders, and we saw this momentum turn in October last year, and we had 2 quarters of the previous year finishing on a fairly strong note, and we were anticipating that this momentum could continue. This being actually a year that is a run-up to the union elections, it was important for the government to get on their scorecards projects which are worthy of being showcased when they seek public mandate. Leave aside the political intentions. I think the fact that India lags in its infrastructure and it needs to compete with the world, which is getting increasingly protectionist in its approach, it's important that we develop competitive infrastructure, and that means good news for companies like L&T, which are well positioned to provide that. So consequently, the order book is at 2.7 trillion rupees, which is fairly robust and provides considerable clarity to the company's revenue streams over the next couple of years. As I mentioned, bulk of this 361 billion rupees came from infrastructure. 54% of the flow was from infrastructure. Hydrocarbon joined the party this year. 13% of the orders came in from hydrocarbon sector. And not to be forgotten, the services business, where we, for statistical reasons, count revenues as orders, because the revenues flow from orders that are contracted out, grew by has a share of 21%. And all the 3 wings of the services business, the information technology, the technology services, and financial services, have turned in stellar performance, and that has helped the group report a healthy increase in the order flow. The order book, which is 2.7 trillion, consists almost 2 trillion, 2.1 trillion actually, of orders in the infrastructure space. So bulk of our revenues for the next couple of years is going to flow out of this pie, followed by hydrocarbon, which has 284 billion rupees, and also followed by the rest in their respective proportion. Getting on to the details of the revenues and profits, revenues first, the company's revenue at 283 billion rupees is up 19% as compared to the Q1 of the previous year. 34% of these revenues come from international contracts. Since we have a fairly large portion, almost 24% of our order book in international contracts, the revenue flows from international contracts as we execute them comes through strongly in the earnings statement. The manufacturing and construction and operating expenses have benefited both by the leverage that the increased volume has provided, as well as the operational excellence program that the company is embarked on across all its business verticals. So consequently, on the back of a 19% revenue growth, we find that the operating expenses have grown by 13%, leading to a headroom for profitability improvement. The finance charge meant for financial services business is part of the manufacturing, construction, operating expenses in a manner of speaking, because money is the raw material for that business. So when we consolidate the interest charges that are paid by the financial services business are treated as part of our input costs. The staff costs are up by 21% from 35 billion rupees to 43 billion rupees. This is largely on account of the staff augmentation and resource augmentation that we have done to create greater capacity in the services business, particularly the information technology and the technology services business. Selling administration cost at 22 billion rupees is up 30%, and these represent the cost provisions that we have made for expected credit losses, as well as the business development expenditure that has been incurred. We do believe some of these expenditure will have their fruits coming through in the subsequent quarters. EBITDA at 29 billion rupees is up 40%, and we have finance cost at 4 billion rupees. This is stable across the year's period, which is good news in terms of finance management. This is being achieved in an environment where interest costs are going up. So it's creditable that the company is able to rein in the interest cost at a time when volumes of business is going up. Depreciation is at 6 billion rupees, and other income at 2 billion rupees is lower as compared to the 4 billion of the previous year, largely reflecting the lower treasury earnings and also the volatility that was introduced into the markets due to the cyclicality of the interest rates. Tax expenses at 9 billion rupees and share of profits from JVs and subsidiary associate companies at 3 billion rupees, adjusted for the minority interest, leaves the company with a profit after tax meant for the equity holders at 12 billion rupees, a 36% growth over the 9 billion of the previous year. In terms of segment performance, there has been one change that the company has made, in fact, two changes. One was the metallurgical and material handling business, which is part of the other segment, has been included as part of infrastructure segment, largely because of the internal restructuring that we have done, bringing that segment under the common leadership of infrastructure. So accordingly, they have been reclassified. Commencing from this year's first quarter, you will find infrastructure segment to include MMH. The other change that we have made is heavy engineering, which included both the process plants and nuclear plants, along with defense engineering, has been bifurcated into defense engineering and heavy engineering. And heavy engineering retains the process plant and nuclear power plant equipments, whereas the defense engineering includes the systems and services that we provide for the defense aerospace sector. The shipyard that we have down south is largely dedicated for the naval application. So consequently, the shipyard has been christened as part of the defense business and clubbed along with the defense segment. So we're going to have the announcements with an additional segment in terms of defense engineering, but to possibly many analysts and commentators' relief, the other segment will get less crowded and a little more easily discernible. Let me start with each of the segments to tell you how it has performed. Infrastructure is the biggest segment, so we start with the infrastructure segment. The segment recorded a revenue of 121 billion rupees, and that's almost close to 10% growth over the previous year. It's not so much about the percentage there, but it is important to note that such a large segment moving at a 10% growth speed is actually good news and augurs well for the company's revenue overall. Out of the 121 billion rupees, we have 37 billion rupees coming in from international projects. As you know, in the past, we have spoken about the orders that we have won in infrastructure space in overseas markets like Middle East, Sri Lanka and elsewhere. And execution of those projects have actually led to the share of 37.5 billion rupees. The EBITDA margins have moved on from 7.1 to 6.8, but this is largely reflecting the stage of execution, and we have actually repeated ad nauseum in this forum that the quarterly margins are not representative of the whole year's margin position. They move according to the dynamics of the job mix and when the jobs reach a milestone stage where margins get recognized. So considering the mix that we have for the quarter ended 30th June 2018, the margins are at 6.8%. But we are very confident by the end of the year, the margins will get back to growth trajectory. The next segment is power segment. It's a segment which is having a lot of sectorial headwinds. We have spoken about this earlier. The opportunities are very limited for thermal, and we specialize a lot on thermal power plant creation, in terms of EPC contracts. And we also do a bit of solar, but generally as a segment, there are a lot of moving parts, and consequently the aggressive competition that goes after the limited opportunities does make this segment's performance a fairly stiff challenge. But having said that, given that we are a very leading EPC player, we are trying to figure out models and opportunities to ensure that we have meaningful role in the opportunities, whatever they be in this segment. We've also stepped outside of the country. We've been doing 3 projects in Bangladesh rather successfully, indicating that the competencies that we have in this segment can be put to global application and need not be restricted to India. We do find that on the back of these orders that we have won outside of India, we've been able to increase the contribution of the revenues from international orders, and they are at 3.5 billion rupees as against the 10.8 billion rupees of the total segment revenue. The EBITDA margins have moved from 1.3 to 4.1% for a quarter. Neither percentages are representative of the true margin potential of this business. And like any other project business, they reflect the cost booking and the revenue and the margin recognition at a given point in time. Even though the segment does oversee the business of boiler and turbine manufacturing, because these are jointly controlled units along with our partners, Mitsubishi Heavy, the financial statements recognize neither revenue nor any of the cost items. It's only the profit or loss of these JVs are added as a line item. So consequently, the EBITDA margins of the power segment excludes the EBITDA margin of manufacturing activity, which generally, by definition, are healthier. Hydrocarbon segment has been a good turnaround story. It always was a good, profitable, dominant segment. We went through a very rough patch a few years ago, but to the credit of the organization, it has bounced back rather well, completed all those difficult projects. We incurred losses, but most importantly, we won the trust of the customer because we completed those projects and handed over them successfully. We do believe all of that legacy is behind us, and the results that you see are representative of the progress that we are making on the current set of orders, which I do believe are profitable. The net segment revenue from hydrocarbon at 35 billion rupees is up 38% as compared to 25 billion of the previous year's first quarter. Much of this revenue comes from international markets because half of our business anyway is international, and hydrocarbon by definition is an international business. So 18.4 billion does come out of international contracts execution. The EBITDA margins of this business is steadily increasing from a situation where we were losing money on projects to a situation where we are up 7% to the current quarter does show the trajectory. We do believe that the best for this segment is yet to come. The heavy engineering segment that I spoke to you about has got bifurcated as mentioned. So just talking about the process plants as well as nuclear plant, specialized custom built equipments for oil and gas refinery sector, etc. The segment has done very well in the quarter. The numbers are far modest as compared to infrastructure sector, but that is understandable given the fact that it is a very niche business and high-tech involves high-tech manufacturing. The segment has done well to have 3.3 billion rupees of revenue, which is a 29% growth over the 2.6 of the previous years. This business is also fairly international. Bulk of the orders that we have picked up in this segment during the quarter are international orders, and clients across US, Europe and elsewhere order our equipments, and they're very happy customers. So the share of international revenue at 1.5 billion rupees is pretty significant out of the 3.3 billion rupees of total revenue. The EBITDA margins at 36% is again in equipment business, and particularly the long lead customized equipment. There are milestones where some of these margins are recognized. So 36.1% margin that you see is a reflection of the situation at hand currently. That is not to suggest that the business clocks at 36% EBITDA margins. So it's very important to understand that these margins will be much healthier being specialized manufacturing as compared to a project business. And I do see that by the time the year ends, they will moderate into more realistic numbers. Looking at defense engineering, which is the new baby, the segment has done well. No connection to the reasons why we are bifurcating. We are bifurcating because internally we have restructured the organization. We have a director on the board of the company representing this business. So we do believe that defense engineering is a business for future, and I think the country would do well to spend considerable amount of effort in terms of policy and procedures to support Indian manufacturing. And we've geared ourselves up. We've been spending close to 30 years in this area, but doing work rather quietly under the radar. But we possibly think that a time has come where the company can showcase its skills in a more direct and forthright manner. So we do hope that Government of India and Ministry of Defence do give us that opportunity. But pending that, just to keep plugging away at growth, we have grown the revenue by 37% at 7.3 billion rupees. And much of this is Indian business, obviously, so you find the share of international pretty modest. And the EBITDA margins are at 11%. This business last year had a negative EBITDA margins, and largely because, if you recall, the segment includes the shipyard, and we made inventory write-downs last year in the shipyard, which is not there now anymore. So the margins are more reflective of the current execution. Electrical automation segment, you are aware that we have signed a definitive agreement for sale of this business, and it is subject to regulatory approvals, which are work in progress. But pending that, we continue to manage and operate the business, and the business has had a good quarter. We do find that there is an increasing demand for standard products. They have grown well during the current quarter. Much of the demand for standard products comes from the building industry as well as the industrial part, including the infrastructure such as metros. We do find that the segment revenue at 12.8%, which reflects a growth of 13.2%, does do justice to the opportunities that are existing. We being a market leader, we do tend to grow faster than the market. If I were to adjust, this being a product business has been most impacted, if I can say that, because of the introduction of GST. So the previous year's numbers, which are comparable numbers, are inclusive of excise duty, and to that extent the current quarter's numbers are excluding those. So on a like-to-like, if you were to compare, the margins are looking at 13%, but you might find that if you take away the adjustment and compare dissimilar numbers, the growth would be more modest at 6%. The product businesses, as I mentioned, are the leaders for this growth, and the margin improvement is largely on account of both better product mix as well as improved realization in the marketplace. Information technology and technology services are two segments in the high technology area that we run. These are two listed companies, separately listed and reported. But for our consolidation purposes, we segment them together. And the segment has done very well, very strong top line growth of 31% between the two of them. The technology services grew their top line by 40%, and information technology business grew their top line by 26%. The margins of both these businesses have done well. They've improved on the back of both the high quality work that they are doing as well as the cost arbitrage that they are able to drive through their models. The EBITDA margins consequently on a 33 billion rupees of revenue is at 24.8%. Developmental project business consists of our Hyderabad Metro, the power development, as well as Katupalli Port. Happy to report that the Katupalli Port divestment has been completed. So we would stop possibly covering Katupalli Port's financial going forward. Hyderabad Metro is work in progress. 30 kilometers have been commissioned, and the balance is fast moving towards completion. Power development project is a power plant that we run in Punjab, 2 into 700 megawatts plant, and we have a power purchase agreement and coal supplies tied up. So these three are the operational businesses which together contribute 14.9 billion rupees to our total turnover, and the EBITDA margins for this business is 30.4. The reasons why the EBITDA margin is also increasing is because we monetized the Katupalli Port, completed the transaction and recorded profits in the books. So to that extent, this margin will moderate itself going forward because the benefit of this one-off transaction will disappear from the charts. I'm also happy to say that IDPL, which has been a set of concessions that we are having in the road sector, has been generating book loss and has been ROE depletive from L&T consolidated financial standpoint of view. And we have been trying to create a marketplace for monetizing the developed roads. And we have been working almost close to a year for creating an investment trust platform. We are happy that in this quarter we have created that platform and transferred 5 assets and booked profits out of that transfer. We do believe that this would be a sustainable way to keep the infrastructure space going by developing projects and having them transferred to a platform which can be held by long-only funds. Financial services has done very well. You would have seen the reports in the press. Very strong top-line growth of 33% at 30 billion rupees. And the profit after tax at 5.38 billion rupees is up 71%. And there were a lot of speculation about the health of the portfolio, and hopefully the results that have been put out will set to rest all this speculation about the quality of the asset. We do believe that the asset quality is pretty fine, and the company's business model is fairly robust to project a growth trajectory which will be conducive for L&T shareholders. The other segment is the residuary segment, largely has industrial products and machinery as well as the realty segment. We do find that there's been some improvement in the industrial environment, and these are reflected by increasing demand for construction and mining equipments and rubber processing machinery, which we supply for the automobile tire manufacturing businesses. The offtake comparative to previous year is lower in the aggregate because the valves business has not been able to keep pace with the performance. We do believe, given the oil price rise with a lag, the valves business, industrial valves business will pick up in the subsequent quarters. The revenue and margin of this business is largely contributed by realty. We have close to 8 billion rupees of revenue from realty business, and we have a changed accounting policy. Actually, it's not a policy; it's a change accounting adoption of a new accounting standard. In the past, realty business were recognizing their margins based on percentage completion. Effective 1st April 2018, they would be recognizing their margins based on projects completed and handed over. So to that extent, you will find that the actual delivery of the real estate assets will be linked to the trajectory that you will find in terms of margins for the realty business. So with this, I conclude the presentation. We've always maintained that this year is going to be a very different year as compared to the previous year. It is going, normally we are little more second half tilted in all our orders, revenues, etc. We did realize that this year, somewhere along the way, the election declaration and hence the code of conduct will begin to kick in. So we are approaching this year as more a front-ended year, and all our efforts are to see how much we can achieve in the first part of the year. You can define the first part as 6 months, 9 months, whatever. But we don't know. But our effort is to make sure that for meeting the guidance for the year, it's important that we are off to a good start. We're not changing it.
You also mentioned about the fact that the order book growth was muted because of the faster revenue recognition. Will that be the kind of scenario that will play out as you try to book more faster revenues in the first half of the year going into the election?
Depends on the type of orders we win. If you win the kind of orders we are winning, whether it is Mumbai Trans Harbour or any such large projects, Dhaka Metro, these are long gestation projects. So to that extent, their conversion takes time. Once upon a time, we used to be very robust on buildings, residential buildings, very quick turnaround projects. So this order book dynamics percentages, what I was meaning to mention is not an indicative of whether the company is doing well or not well. It more is an indicative of the mix of orders that we have.
So you continue with the same guidance?
Absolutely.
And
Give chance to others now. Anybody else?
Okay. On the impact of Kathakuli and the change in accounting standards for realty division, how did it impact the margins, and if you remove them, how were the margins?
I don't want to remove them because they are in there. 355 crores is the profits that we made out of Kathakuli divestment. So 350 crores rounded off for your convenience. And the Ind AS is actually 115. We adopted Ind AS 2 years ago. It is just that accounting standards for contract revenue recognition kicked in now. And what it essentially means is that when we were booking revenue in a more linear fashion, as we were completing projects progressively, revenues and margins were being done. We are going to now see the revenue build up not being as linear, could get a little more lumpy until we come to a situation where the handing over of flats is a very constant stream of equal number every time. So it would depend on what is the delivery schedule of the various flats. For example, even in Q1, we delivered a bunch of flats in our Parel project. So much of the revenue growth came from delivery of those. So I think this will stabilize. This is not going to be material from L&T's context, but it is a change that you should know.
Sir, as far as the non-core asset sale is concerned,
Non-core
asset sale is concerned, any update as far as 2019 is concerned on that?
We don't make speculative comments on it as and when if something happens. There's been a standard statement and I continue to make that.
Could you elaborate which segments are non-core now, like which you are looking to, which you may look to divest in future?
See, you look at the company, it's broadly into 4 areas, right? One is the construction, infrastructure construction, which is the major part. There's EPC projects, which is hydrocarbon predominantly. You have the manufacturing, which is basically heavy engineering and defense. And you have the services business, which is our IT, technology services, reality and finance. So this would be the core of the company as we go forward. Now, we could, many of the other businesses which are not strictly part of this, if it doesn't make sense for us to continue, we would try to evaluate the business to see where it should be. And as we go into the future, if we see more exciting businesses that we need to enter into, it may be part of the core, we may take a lateral view also. So that's an option that management always keeps looking at it, and we'll continue to do that as a forward-looking group of people who want to take the platform to a higher level. Yes, sir.
Sir, during RSR's presentation, he spoke about the fact that the hydrocarbon segment has bounced back after the phase of difficult projects and losses. So, if you could explain how did you manage to overcome the legacy issues in the hydrocarbon segment, and also as far as the regulatory approvals on the Schneider deal are concerned, do you expect any obstacles on the CCI front?
So the hydrocarbon business is now turned around since a year, and the basic reasons for turnaround have been many. It has been, new leadership has come in, we have shut down some offices, we have looked fresh at some of the businesses, we have managed to close down some of the legacy issues, we have gone to the clients and got some reimbursement or claims in our language back. We've been lucky enough to get some good contracts where the performance has been far superior to what it was. We've done projects on time, we've done projects ahead of time, the business has been charged up, people are enthusiastic, and many things have gone into making the business what it is today. Top of it has been the leadership therein. Mr. Colleague Sharma has played a fantastic part there. So that is that part. And as we look into it, I think now with the oil prices going up, we do seem to be a little more optimistic in that business. Plus we've seen some kind of revival within the Indian domestic segment. We got the fertilizer order, we've seen some business from HPCL and ONGC as well as from Kane and HMEL. So we seem to be positive about it, and let's hope that continues. From the electrical automation vertical part of it and our ongoing deal with Schneider, As told you many times, we are in the advanced process of submission to the regulatory authorities and to get their approvals, and we do expect the process to go forward. If there's anything which is of significance to be mentioned about, we will mention. But as of now, we are going forward with it. Yes.
One more question. Let me slip it in. RSR, you spoke about the fact that L&T is second half tilted in terms of orders and revenues, but you also mentioned the elections coming up. How much of a pressure will it be for you to milk the environment in the first 6 months so that you can maintain your guidance?
The statement that RSR made is from the fact that we know that this year is election tilted at the later part of the year. There are 3 major states going for elections, and there's speculation on central government elections. What happens during elections, as you know, is there's a 1.5 month prior close out in many states as decisions don't get taken due to the election code of conduct. So what we have done is put in place a mechanism by which we are trying to see how to also move the orders in the early part of the year. When we say the early part of the year, the first 9 months of the year.
Right.
Now, it doesn't mean we alone are trying. The elections are also nowadays geared towards the fact that people look to governments to see how much of developmental work they have done, and that's what you go to the people for votes beyond other points. And therefore, there's pressure on the governments also to dwell out as many as possible in terms of orders, or take out as much aid funds as possible or multilateral funds as possible to push out many projects. You see some decision making positiveness in all this. We've been a beneficiary of it. We continue to hope that second, third, and probably to the extent of even the early part of fourth quarter, there will be some beneficial situation for us out of this. It's also coupled with the fact that Middle East is showing positiveness because of the fairly steady oil prices now at 75 rupees, $75 per crude. And our forays into other geographies like Africa and Asia are also bearing fruit. So overall, we seem to be okay with where we are. So let's hope it pans out well.
Thank you.
And just to supplement, if you are intending to ask whether pressure means reckless bidding, answer is no.
Okay. That answers my question.
Yeah, I know.
Also, sir, as far as margin is concerned, could you give us some guidance in terms of how you see it panning out, and also what were the core margins in the first quarter?
The core margins are in the presentation that I made, and in terms of infrastructure segment, they are at about 7%, and manufacturing is much better. In fact, segment by segment, the margins are there. Suffice to say that overall for the year, we have put out a guidance of 25 basis points improvement over the margins that we reported for FY18, and we are on trajectory.
So, I have a question on the infrastructure business. A lot of projects, flagship projects, have been bid out. Now, what is ahead? From where do you see growth? What are the projects that you are looking to bid for? Some of the flagship projects.
Good projects have come out. A lot more good projects are expected to come out. We will bid for it and we'll try to get a share of it. Now, we don't get into specifics of what's coming and what we're going to bid for, but I think we see traction in all the infrastructure verticals. You see orders in all the segments, and I think one should remain positive on that. Yes.
In the order inflow of the first quarter, how much has been the government and how much has been the private sector? Is it completely the government driven?
Predominantly. The bulk of the spending in India is through the central state governments, is through multilateral funding towards the central state governments. There has been some private orders, but it's predominantly driven by government orders.
So is it, do you see things improving in an election year in terms of private investment side, or is it the same?
Some improvements will be there, but nothing drastic to feel gung-ho about. See, there are private sector investments happening in certain areas, certain sectors, like maybe retail, maybe telecom. That's not EPC driven to that extent. These are more in terms of handsets and networks and network solutions and such like that, which is not part of what we do. Retail expansion is taking place, but this is again not part of what we do, unless there are huge Walmarts and stuff like that coming in, which is not the policy right now. So it's not to say that no private sector investment is happening. It is happening in certain sectors, but not in the sectors where we need to see it happening. The core sector, the manufacturing, industrial, The infrastructure sector private investment will take some time to happen, and I don't see it happening before the elections.
Thank you, sir.
Yeah.
So I have a couple of questions. One, your release mentions a provisioning for the realty project. If you could share details on that. Second, any specific reason to bring the MMH department under infrastructure, bring it under the same leadership? And third, if you could give me some color in terms of what orders are expected in defense in the same context of it being an election year and there is an election agenda against around defense right now.
So if you remember all the questions,
Yeah. So we'll ask her to repeat. In development project business, disputes are bound to happen. So we had in reality a project, obviously since the matter is sub judice, I can't get into details of that. But there has been a dispute around the developmental right, and we had incurred expenditure in developing the project this far. And as accounting prudence demands, because it is a disputed advance, we made a provision. Now this doesn't mean that the amount has gone bad and the company has given up on its claims, but it's more of prudent accounting. So nothing beyond that really, because the matter is lying in the court. Insofar as MMH, I think it's a natural. Earlier, when we used to be divided a little differently, where all the construction businesses, regardless of their segmentation, were together. Industrial construction was part of construction business. We were straddling civil, electrical, mechanical, all forms of construction, so industrial was very much part of it. We sort of artificially yanked it out when we defined infrastructure segment and put it under other segment. But at some point in time, I think the synergies that are at play, be it in terms of using the facility, using the design, using the equipments, etc., become more important than the schematic presentation. So we felt it is the most natural thing for it to get back to the construction scheme of things, and that is how from others it moved back. Because of the construction business is managed by two leaders today or executive directors. So one of them, this responsibility has been handed over, in addition to the other responsibilities within construction that that particular gentleman carries. So nothing beyond that really.
Is there scope for more similar restructuring segments?
No, it's actually a reflection of company's mindset. I think we are alive and agile to developments around us. I think whatever that makes lot of business sense for the company, its shareholders, whatever it makes value proposition to the customers, I think the company will continue to keep doing this. And I don't think we would like to straitjacket ourselves in any of these things. Suffice to say, I think we would not do something which is just for sake of convenience internally. It will be done for a business purpose and reason. The third question.
Defense.
Defense, that you were only.
It's a good sector to be in, and we have prudently over the last decade or so built some strategic assets to make the country fairly self-reliant. If you take a ship now, nearly 60% of the weapon systems in a ship, including radars and others, are made by L&T. If you take the K9 gun program now, it's practically indigenized. It's already 65-70% indigenized as we go along, except maybe for the barrel, we're trying to do everything within ourselves. So it's a good business to be in. The fact of defense, and I've said this many times before, is that it's a sector where, being a diverse and geographically spread country, we have different climates. We have the very hot climate in Rajasthan, we have the very cold in the Himalayas, we have the rainy, wet and inaccessible areas in the northeast. So, and being not such a rich country, we cannot have three types of weapon systems for the various areas. We can only have one. And therefore, a lot of due diligence and fair amount of exercise goes into choosing the right weapon system, definition of it, so on and so forth. And therefore, from the time they conceive it to they order it, it's pretty time consuming. One needs to have the patience. I think we have done well so far, and this is an area that we bet for the future. We'll continue to add to our asset quality here. We'll continue to invest in people. We'll continue to invest in engineering, and we do look at it as one of the thrust areas or growth areas within our portfolio. So whatever it takes to grow this area, we will do, and it's a long-term bet from our point of view.
Yes, on the issue of defense, you've been there in that sector for 30 years now. now that you have bifurcated as a different segment, what is the kind of capital returns that this segment will be generating, and will you be sharing that with, because it's not giving you enough return, kind of proportionate to the capital you've invested over a period of time.
No.
Of course, it's a capacity building which you have put in, it's strategic in nature, but at the end of the day, the shareholders would also ask about the kind of capital which has been employed and the return that it's generating.
Okay, let's look at it in two ways. The present numbers that you see under defense engineering are basically of two segments within that. One is the defense and aerospace business, which was a traditional business that we started with, which is doing fairly well. The second was a shipbuilding business, which we added to it. The shipbuilding, as you know, we have invested fair amount of money at Kadupalli, and we're doing reasonably well there with whatever orders that we have, but the interest takes away much of whatever little money that we make there. So unless that business grows in volume, you don't see returns out there from that point of view. And that's a conundrum within us. We bid for some programs. Unfortunately, in some of the bids that we did, we found the public sector bidding very, very competitively for various reasons. One of the reasons that we have in mind is that they've been heavily nominated into many programs, and therefore there was fair amount of money there from those programs which they could use it to leverage the new set of orders that came. We don't have that luxury. We have to treat each business as that business. We don't want to take money from some of our most profitable business and put it there just because we invested in it. That's not the way to run a good balance sheet of P&L. So having said that, this is a business that we invested. We've done some very marquee projects. Many of the vessels that we have done, including the interceptor boats, offshore petrol vessels, the floating dock, etc., all been done ahead of time. And we have advertised so. We have Ministry and the Navy and others, are, of course, are aware about this. There's a lot of appreciation to the fact. Now, after our advertisements, you find many other companies also advertising to the fact that they're also doing on time. So it's a good thing to have. This is the Make in India stuff. And therefore, we need to have some luck to win some good orders in the shipbuilding. We're not going to give it up. It's a long-term play. So we'll see how to get those orders. And once we get it, you'll find defense and aerospace plus shipbuilding will be profitable. And will give the returns that many of other business give and much more. So we'll have to drive that. We are passionate about it. We are involved in it. We are emotional about it. And we'll see how to make the gains out of it.
But do you have the near-term visibility of those orders coming in?
In defense and aerospace, yes.
About Make in India and the kind of orders that it will bring in, but it's not happening on the ground.
No, one shouldn't say that. In defense and aerospace, we have had the orders. We've had, I can't divulge the details obviously, but some of it is on the press, like the K9 Vajra is a fairly big success. Ahead of time, we have done 10 guns, and I think next week or next couple of weeks, the Army is taking it over, including the firing is going to take place in Bangalore one of these days. So that gun is getting handed over much ahead of schedule. There are other programs that we bid for. We will see some traction. The regular, what you call the multitude of orders that we get to keep the lines busy, that we continue to get. What is not happening so fast is the shipbuilding. Let me get down to that. So that we need some luck to pluck a fairly big order out. That business will break even or show profit after interest if there is the turnover from about 700-800 crores today goes to about 2,500 crores. That requires a big program, otherwise it won't get to that. So that is what we need to try, and that's what we're trying.
So as far as the resolution of...
Can you use the mic, though you're sitting in the front?
As far as the resolution of stressed assets is concerned, and given the progress the insolvency proceedings have made in the past few months, do you expect any improvement taking place in bank credit flows for the infrastructure sector?
I'll try because I need to step into bank shoes to answer this. Much of the bank's credit growth in the past 10 years have been on the back of private sector sponsored infrastructure projects. So much of the NPAs are also in sectors which are infrastructure by definition. Each bank has its own strategy, government has its own strategy. Much of the funding has been done by PSU banks. The private banks have not participated in infrastructure space as much. So they are stressed for a different set of reasons, be that it may. We do believe that the resolution is going to be an important step in unlocking credit flow from two perspectives. One is it releases the capital to lend for the banks based on settlement, which so far has been eluding them. And secondly, it provides possibly a fresh lease of life to the asset that has been created. Unless the asset that has been created is substantially low in value in proportion to the money spent, I think the utility of all these assets lie in their use. So I think the effort of all the concerned party is to make sure the assets don't go waste. The capital that have been sunk in, maybe a portion will get sacrificed, but it could well worth the cause if the asset is put to good use and returns are generated out of the asset. So I do believe in the medium term this will get resolved. It's not going to be very simple because we are a very complex country and the procedures are very, very tedious. There are courts to which you can appeal based on decisions. So it's not a one-stop solution structure. So everybody would exercise their rights to see, how their interests are protected. But I do believe that resolution will lead to credit flow.
And that has to happen in the medium term.
I think so.
Thank you.
Mr. Ram, you are also an operation creditor in many of these cases, right? What has been your experience when you're dealing with those cases?
In one case, not in many. Fortunately, most of our clients are healthy, and that's good news. In one of the cases, we are an operational creditor, and I think
the matter is sub judice. You will get to hear of it shortly. Yeah.
Boss is always right.
That's the easy way out, right? That's the easy way out.
No, it's not an ECO. That's a fact of the matter. It's in courts, and we hope to have the resolution shortly. That is the way out of it. That's not the easy way out of it. I wish it was.
Yep. Mike.
So this current asset sales that are happening because of the insolvency, does it in any way create any opportunities for you?
What's that?
No, it says the assets that are being sold under insolvency proceedings, is it an opportunity for us? Have I got your question right?
Yeah.
No. Answer is no.
You're not at all.
No.
Sir, can you throw some light on the debt picture of the company? And as far as staff augmentation that you mentioned, is there a number in terms of addition to the workforce?
The debt picture is pretty. We are very under-leveraged company. Debt equity of the parent company and its immediate connected business enterprises are about 0.21 to 1. So that's fine. Much of the leverage comes from financial services and developmental project business, which are anyway independently sourced with no recourse to L&T. So aggregation might look a lot, but in effect, we are a very debt-light company. What is the other question you asked?
Staff augmentation.
Oh yeah. No, this time I've learned my lessons. Whenever I talk about staff augmentation, the headlines come saying how many people we have laid off rather than what we actually do. All that I can mention to you is I think we are trying to invest in resources, in businesses which are looking promising, and we'll continue to do that.
No, and one number which I remember is I think we took about 1,500 GETs for the year. They just recently joined about one and a half month back. I think other than that, there's been regular hires or retirements and such, nothing else.
Sir, I just wanted to ask, what is the profit on your InBit divestment? I mean, how much did you profit on that?
We made about 400 crores on divesting 5 roads.
And does your operating profit calculation include the interest cost on the financial services business?
Yeah.
Okay.
One last question, please.
So Mr. Nayak had also said that you would be looking at acquisitions in the IT and artificial intelligence space. Any development on that front?
As and when we do, you will be the first person to know. Okay, thank you, ladies and gentlemen.